So ladies and gents, we are live from Miami, and if you've been watching the vlogs, you've seen the cool things we've been up to: private jet, villas, podcasts, everything that we've been doing with the team. But in this video, I want to show you how you can do all the traveling and still find great trading opportunities. You've seen the MyFX book, you've seen the TradeZeller, you've seen the live callouts, you've seen the 7 months of live trading, 60 trades given live ahead of time, 50% plus gain. So I'm not going to do all of that proving stuff again in every video, but let's get right into the point, which I want to show you a trade of today where despite market structure, despite trend lines, despite Fibonacci, despite supply and demand, despite everything we're taught, including smart money concepts, all of these things would have led to losses. Rather, if you just follow the daily cycle, time-based manipulation, lower time frame confirmation, and inducement of the day, that will always carry you through. I've been a firm believer on this channel. In fact, if you go back through all of the videos, I've shown time and time again a catalog of evidence why support and resistance does not work, why trend lines do not work, why Fibonacci, smart money concepts do not work. They are all targeted to this concept or idea that you need to utilize the essence of the market, which is liquidity. Liquidity is generated and taken, and therefore the word inducement is something that you have to focus on. In this video, I'm going to show you how the inducement of the day, how to identify it, how to trade it to your advantage, and despite whatever strategy you have, you would have taken a loss today. But if you just follow this simple step of inducement of the day, you'd have actually had a phenomenal trade in today's session. So looking at this segment of price action, we can see that price was bullish over here. Higher high, higher low, formed a higher high, formed a higher low, formed a higher high. So the buyers are going to be interested. But we look left and we say that even though price came off this demand level, price has actually come to this supply over here that led to this low, that had a lower high, that failed to make a lower low. Price came into this supply level over here, gave a reaction. So we need to see, why did price come here, give a reaction, a bearish reaction, and then overall induce the zone, and how it would have trapped sellers in also. So when you have a bullish breakout and an inducement of a supply, you're in a zone of indecision. When you're in that zone of indecision, there is great opportunity because there's going to be great inducements and manipulations. So this is how I want to show you how you orientate yourself despite the bullish breakout, despite the supply zone, despite market structure and trend, how there's more important things, even if you add in trend line and Fibonacci. Okay, so looking at a little bit more context on the left, we can see that we have this supply zone over here and this demand area. So this demand area was not a genesis demand. It was not a beginning of a trend. It was just a form of demand. So price can come lower to this area or even lower. But then we also see that this supply area that led to this push down, maybe we start to have this bullish price action where we have a complex pullback coming up from higher high, higher low, higher high, higher low, higher high, all the way to this supply zone. We have the higher low, higher high into this supply area on the left. And then maybe that's when we start to go lower low and form that bearish trend. So there's a lot of things to consider here, market structure point wise. But again, this is the highest of time frames. So how are we going to utilize that information for today's trade? So we know that there's a possibility price can come lower to this demand area. And if price comes lower to this demand area, it makes sense to potentially buy because we know this is a higher low that made a higher high. We also know that price can come to this supply area because it's a high in the market that made a new lower low. So we know price can go to that supply zone and start a bearish trend or bearish reaction. So also to consider is this zone, a lower high that made a lower low, has been induced and we've grabbed that liquidity. So we're getting breakout traders interested. We're also getting stop loss hunts of sellers. We're also getting price doing that manipulation, more of a premium. There's a lot of things that can happen. So let's jump down to a lower time frame. I'm going to go straight from 4 hour to M15 and let's start investigating exactly what happened here. Straight down to M30. So we're on the 30-minute time frame and analyzing it here. First thing we need to say is this an inducement? We've cleared a higher time frame supply area, and if it is an inducement, we need to confirm it, because if it's an inducement, we need to look to sell. So what are the telltale signs? Is a break of structure is a good one. So we say that, okay, the last area, the higher low that made the higher high, did it form a new lower low and therefore a break of structure? And in this case, it did. This is the higher low that made this higher high, took out the supply area, and now we had a lower low and a break of structure right here. But we have to be careful because structure is not king, inducement is king. And when we notice this from another lens, we had a buildup of liquidity here, like so. We had a inducement right here and led to the higher high. This inducement zone, this run of liquidity, actually ended up getting induced. So this is a very clear smart money trap, because this should have been a demand area that should have held because it was equal lows, run of liquidity, new higher high, breakout traders, demand area, order block, fair value gap, everything is there. And despite price coming into this zone, we had a first touch over here, we had a push out, then price made a higher high, and then price made a higher low, price made a higher high, we had this ascending trend line, another higher high, all of this getting an inducement right here and then taking it out. So this inducement high was the fuel to bring price lower to do what? Take out the smart money trap. So when we see this over here, a lot of people are thinking bearish break of structure and therefore a seller sign. We are seeing it from another perspective, which is that is an inducement of a smart money trap. This is already a sign to say this was not a real inducement. Rather, the real inducement is here. Okay, so when we are in between two zones, we had an inducement on the left over here of a higher time frame zone. So we have all of that liquidity bringing in sellers. And we also have an inducement of this zone bringing in buyers. That's what the market is, a tug of war between liquidity. We have an inducement high, we have an inducement low. Market structure is neutralized. Smart money concept is neutralized. The only thing we can look at is now daily cycles and further inducements. So when I'm looking at from this perspective, I'm going to add on the liquidity points. So trend line, for example, and you can mark that in many ways. Another one could be like this, for example, a few touches over here. But we can see that sellers are interested after the inducement and break of structure to sell upon a trend line. So this is a zone people could be interested. This could be a zone people are interested in. It's the problem with trend line, how subjective it is. We also have liquidity right here. All of this liquidity pool. We'll be interested to see what happens over there. Despite all of that, we have lower low, lower high, going on to make a lower low potentially. Trend line, higher time frame supply zone inducement. These are signs that sellers would be interested. And we also have signs that buyers could be interested because of this bullish breakout. But we have no bullish intent on this time frame. No bullish break of structure, no demand areas necessarily. So we're in that still indecision zone. So we go down to a lower time frame for clarity. And this is where I'm going to go to immediate price action of this specific week. And I'm going to see that, okay, where, first of all, despite this bullish trend that we can see, internal higher highs, higher lows, higher highs, higher lows, despite all of that, how does it fit into context? And who's in control? That's more important than market structure or SMC, is control. And when I see control from this lens, which is a buildup of liquidity here, a inducement over here, a run of liquidity. This for me right here is indicating that buyers should be in control. We had this run of liquidity and inducement leading to a higher high. So therefore we should have a higher low, higher high. That's what everybody's going to be thinking. Market structure traders, supply and demand traders, SMC traders, everyone's going to be thinking that. And when I plot in further intraday liquidity, I'm also going to be seeing this very obvious trend line that buyers were getting in on has now been taken out. Worth considering. We also have this area on the left right here that is equal highs or a liquidity pool that got induced by this level. So when I see that inducement over here, that led to what? Led to the lower low, which was the inducement in the end. But for market structure traders, that is a inducement high to make a bearish break of structure. All of that combined tells me supply zone. So this is the problem with retail traders. Depending on what strategy you pick is what your narrative will be. And all of these things are correct. They fit into every single strategy depending on how you look at it. But you need to look at it from an objective place, which is the essence, which is liquidity. So even though we have a supply level that made a lower low, this sellers over here will probably fail. Despite this trend line we've marked, that level will probably fail. Despite this smart money zone, equal lows, inducements, higher high, probably will fail. Despite this ascending trend line, it's already failed. So you can see how time and time again, and mark another one for you. We have this equal highs over here. Smart money traders love that. Smart money traders see this sweep, their fair value gap, everything there. They will be entering there, but it all was a trap. You can see how those traders got taken out. I mean, I can go on and mark all of these things out. We have this base, these equal lows liquidity. We have this run of liquidity here. We have this higher high internally because you had a break of structure. So we've got build up, run of liquidity, sweep, fair value gap, order block, everything. Price respected it, but I'm going to show you how it's not always going to respect. So without getting into every liquidity pool and every trap, let's see what is most relevant for today's price action. So what I'm going to do is typical retail trading will be looking at a Fibonacci level. So you pull your fib from the last higher low that made the high to low, from the low to the high, we pull that Fibonacci level. Now upon this zone, what a lot of fib traders going to do? A lot of traders are going to wait for this demand area, which is the higher low that made the higher high. In fact, we have a full order block right here with the fair value gap prices tapping in. We also have the fib levels. So we have market structure, demand traders, smart money traders, Fibonacci traders, and so forth. This trend line already got taken out. Now let's go a couple of candles forward and see what is happening. Oh, well, first of all, right away it's getting induced. So if I come to a lower time frame, just to show you on M5, we can see that price was stalling on this fib level, on this demand area. So why is price stalling? It's showing you doji candles. It's showing you reversal patterns. Why? To invite traders in, to invite stop losses in on a fib level, on a demand level, on an SMC level. All these areas, traders are going to be getting in. So very quickly we see that this zone was not a real zone. In fact, I was just about to say it. It's a smart money trap. So the way we can identify that is through the daily cycle. The main things to mention here is we have a demand area that's very obvious. It's a smart money zone. And when price arrives to this zone, it's out of a key time window. But more importantly, where is the lower time frame confirmation? There is nothing within here. Despite the doji candles, as I mentioned, it's usually not enough. Market structure misled you. SMC misled you. Everything misled you in this case. This level got induced. Now, when price has made this lower low right here, what are people thinking? Sell stop, break of structure, looking for sells. So what a new smart money trader is going to do, they're going to reorientate and say, okay, this zone right here is the zone to sell from. And why are they going to think that? They're going to think that because all of this liquidity we can see, 1 touch, 2 touch, 3 touch, 4 touch, that was the run of liquidity sweep that led to the break of structure. So they're going to be seeing this trend line that I've marked out, the previous supply zone, and then the break of structure forming and say, okay, I'm going to wait for a retracement for price to come higher now to then look to sell in New York. And that will be the SMC market structure narrative. Notice how these breaks of structure can be very confusing and how breakup structure and inducement can be quite similar, but how you read them correctly will be a make or break factor. In fact, I made a video on this channel not too long ago specifically teaching you the difference between a breakup structure and a inducement in that point where they overlap. When they are exactly the same, how do you know which one to pick? And that's important, so go check that out. Now, what I actually did in this price action was I watched it play out, and I'm always waiting for the inducement. I'm waiting for the inducement of the day. And it's not just a sweep of Asia high. You have to add more context in, add more confluences in. And for me, I like smart money traps and I like market structure traps. Those traps usually are medium or major inducements. In this case, we had a medium inducement. Not only did we sweep Asia low, which is great. We also had SMC trap building above, which is a liquidity pool to target. Not only did we take out the SMC traders and the fib traders and all of these things, we have this trend line above, which is going to be a target for us, a liquidity target. Now I have everything showing me that right now the market is bearish. From a sweep of SMC, from the break of structure from market structure traders, all of this trend line is showing sellers get in. So market structure is going to say, once price comes to this level, sell once again. Again, we're not falling into the category of retail traders or what every strategy is, SMC and blah, blah, blah. We're looking at liquidity pools and inducement of those liquidity pools in meaningful zones at meaningful times. So when I've seen this cause, which is a potential medium inducement of a SMC zone, right here, we can see the build up of liquidity, the run of liquidity, and then the higher high. Price came back to the zone, gave a small reaction, induced it. Now, I can't just jump into a buy because I have no confirmation. I have no reason to get in until I've seen confirmation of reaction. So as I see prices starting to come into the zone and climb higher, I see price comes to this trend line and gives a reaction, inviting sellers in once again. Who is it inviting? Market structure sellers right here, potentially on that supply zone, also inviting in potential SMC traders who are seeing this run of liquidity push down. The market will usually give a reaction and then we have that taken out. Now, when I'm seeing this shift, I'm seeing that supply zone and SMC zone potentially getting taken out. I'm not so concerned with that. I'm more concerned with the market structure shift. I'm seeing actually a bullish break of structure. And once that trend line is also being induced, we've had a bullish break of structure. Now the law of cause and effect is coming into play. We've had an inducement, which is the cause, and an effect, which is the displacement and bullish intent. So when I analyze this, we have a bullish break of structure. We have large bullish candles with momentum. We have large imbalances. We have time on our side in the sense of, look how long it took for price to come down. Very slow retracement, slow retracement. We look back, look at the speed of price. Very slow, very choppy. And then once price is ready to move in the real direction, pretty instant. So this price movement down was slow. The reaction was fast. This shows me intent. The displacement is confirmed. And then it's a very simple thing of looking for the refined zone. And that is the last step of a trade, is to find the lower time frame confirmation, the lower time frame entry. So we know it's going to be somewhere within here. So in this case, when there's not a specific IFC or refined IFC to target, you have to get a bit creative. So that's when I jump time frames and I say, okay, what does the M5 look like? The M5 would tell me the demand area is this. The M5 would tell me that the zone is right here based on that imbalance. The M3, let's say, will tell me probably something else. M1 is going to tell me maybe here, this is the imbalance. When multiple time frames come into the same zone, that gives me confidence. And just for the sake of a buffer, remembering the definition, it is the last sellers and first buyers before a break of structure. That's usually what I follow, and I look for that imbalance. So that's the definition I have. So just for a safety net, I can either go for the straight imbalance, which would be right here, and that would give me a 4 pip stop loss, or I inflate it slightly to have that definition of last sellers, first buyers before a break of structure, and I'll make myself a 5.5 pip stop loss, both within my acceptable range of 3 to 7. My break-even point's right here upon a market structure shift, and then my first TP at a 1 to 3 risk reward right here. So that's going to be my TP point 1. As always, as standardized, as I've explained in many previous videos on why exactly I do that, data-driven approach to find optimal profit levels. And then break-even point needs to be systematized also, and that's going to be in this case here. So once the trade has been planned and everything is good to go, you set all your levels, you set all your notifications, you set your limits, stop loss, break-even point and everything, and then you allow price action to do its thing and you watch it navigate each zone. So this is the retracement that we're hoping for to come back into the refined IFC. We can see prices coming to the level I mentioned right here, tapping in. It's actually coming to the preferred area, which is the imbalance closure. So I could have done the 4 pip. I went for 5.5. And then you can see right as it's tapped in, we're having a small build up, small inducement, and then we're seeing a bullish break of structure high. So we're seeing a liquidity cycle on M1. So perfect. This is a confirmation I like to see. And then I just want price to continue to tackle my break-even point. And once it's there, then I can make a decision on if it's good to break even or if I should do a partial break even. I see prices climbing in a healthy way. And as soon as price reaches here, I break even. There's nothing to re-encourage me to say there's inducements. That would usually be good if I saw, for example, a build up here and then an inducement here. In this case, I didn't. It was just healthy price action. So that's not ideal, but I want to see momentum kick in. I want to see intention. I want to say New York Open is around the corner. This is a good sign because I know there's maybe a trap and then momentum of the New York session. So I wait for New York session to kick in and price is going in my direction anyway. And as price comes in, I see, okay, this is now coming to my New York Open. And what has price done in that very quick moment? Price has come to the potential supply levels that traders would have been interested in. for example, here. So supply levels inviting traders to get in. Also, if we do it from a Fibonacci perspective, from the high to the low, price came into the 61.870 zone upon that supply area, which is an order block. And then what did it do? Gave reaction, gave breaks of structure, gave a trend line, gave everything traders would have needed, but they forgot the context that the inducement of the day is down here. So you have to trade away from it. You can't fight the inducement of the day. That is the king of the day. If the king of the day is showing the buyers are in control, until you have evidence otherwise, you have to look for buys. And any sells on trend line, upon supply zones, upon SMC zones are all going to be false. So this supply zone failed. This Fibonacci level, 61.8, with lower time frame confirmation, failed on New York Open. This SMC zone that we identified at the beginning of the day as a trap, which has a build-up of liquidity, a sweep in Frankfurt Open, and a break of structure, all of these things led to failing. This higher time frame trend line failed. This supply zone right here, watch, is probably going to fail because we are with the inducement of the day. And then this key window that I like to trade, that's my New York trading window. Price is coming into that time window where I'm expecting even more movement. Price comes in. We invite sellers upon that supply zone. We get a bit of consolidation. We get an inducement of the zone. And then eventually we're going to see who's really in control. Despite the supply level, buyers are in control. So that supply zone got taken out also. So if you just follow the inducement of the day, which is the king, every other strategy would have misled you from the higher time frame, which I already mentioned at the beginning of the video, to the M1 and everything in between. This was the only way to trade this kind of day and most days. So this supply zone over here got taken out. This SMC zone got taken out. Everything will be taken out as long as you are with the inducement of the day. And then as you follow through the rest of the session, rest of the day, which was today before I came to the studio, we could see who won. And that was a 1 to 3 down there. And then 1 to 10 was achieved around this area. So very simple trade. Lower time frame was easy. Identifying was actually very easy. The hard part was putting it together and knowing that despite all of these temptations of trend line, Fibonacci, and everything else in between, the key was identifying the inducement of the day, all of the traps, and knowing how to trade it. Once you've identified it, simple M1 break of structure. Simple lower time frame confirmation. So in this trade specifically, you know that I have a fixed risk system and I also have a fixed profit taking system. So in the end, trading is about percentage gain and trading is about risk to reward, and your main KPIs, win rates and so forth. But in this case, based on the account size that I have and the fixed 1 to 3 and 1 to 10 take profit levels, they are fixed. They will never change because they are optimized for data. This resulted in me having a full TP trade. I reached my 1 to 3 risk reward and in the same session reached the 1 to 10 risk reward. Therefore, I had a full entry and exit within the same session, netting $25,000. So ladies and gents, you can see on the screen right here, I have my broker sync journal. TradeZeller, I've been utilizing it for over a year now. What it does is automatically syncs to my brokerage, all the positions I take, imports it directly to TradeZeller, and then it will go through and document everything, give all of the reports, all of the key data that I need to stay on top of my performance and help me journal my thoughts, the playbooks, the trade types, and then overall have depth in my analysis to say, okay, my A+ setups netted this, my B+ netted this, these trade models netted this, and then overall P&L, of course. But you need to have these insights to truly track your system and truly track your performance. Okay, so on the screen, you can see now the exact position that I took. You can see the price action that is the same that I already mentioned. And the exact trade reasoning was, as we've covered already, the main thing to identify, despite all of the analysis, was the inducement. So we had this build-up of liquidity, smart money zone, and bullish break of structure. Price came back, induced the level. So this set the directional bias because it gave us an inducement to trade away from. So when we saw this inducement to trade away from, and then we saw follow through inducements on an intra-session level, which was the next one. Let's go down to M5. We already have the previous reference of the intraday inducement. That sets the frame. That's the first domino. And then the cascade of dominoes afterwards is what we trade. So when we see this next level, which is a build up of liquidity, run of liquidity, bullish push out, and then price comes back and does a wick down. The only reason it does that wick down is to do an inducement. It's only to grab stop losses, nothing else, because then price took out the supply level as we mentioned earlier. So when we have that manipulation, this is a cascade, this is a follow through event. So when we see the first inducement that is intraday and then follow through inducements to support that intra-session, this gives us a wonderful trade idea. And then we had our lower time frame execution points to enter this trade. And then as you can see, I executed right here on this candle with this stop loss right here as already broken down. And then the first take profit level was at the 1 to 3, which was on this candle. And then the second take profit level was on this candle. So this overall trade, my first 1 to 3 target, my 1 to 10 target, and my 2 exit points, therefore my partial points. And it netted me overall here. As you can see on the left, I had 75 lots taken on the trade. We have 35 pips gain overall. My initial stop loss being here, therefore my assumed risk. And as you guys know, 1 to 3 risk reward, taking 1.5 R when you take a partial, 50% of the volume. And then you take the remaining volume at 1 to 10. So 1.5 plus 5 equals 6.5 R. So that's exactly what was achieved here more or less. And there we go. There is that trade position. So hopefully you can go through this a few times to understand the the intricacies of the exact trade, and hopefully you can utilize this exact same trade model, or at least the principle of setting an intraday inducement and then follow through intra-session inducements, find the inducement of the day, and always trade away from that. SMC traps are real. In this video, I think I've shown you 5 or so in just 1 or 2 days price action, and how SMC traps are getting induced all the time, and that's how identifying that will help you navigate the real direction of the market, despite the trend line, despite the higher time frame, despite the lower time frame, despite supply and demand, despite everything in between. The king that you needed to actually trade profitably was a partial system, lower time frame confirmation, but beyond all of that, the inducement of the day. So hopefully you found this video important and useful. And again, as I always say, the key to everything is not the concepts. The key is how you put it all together in application. And the only way that works is if you're restricted. That brings me to my saying, a restricted trader is a profitable trader.